if you think about it, it's not 100 to 100, like 100K in taxes doesn't equal 100K in real estate. Maybe you took that 100K that you're not paying in taxes as a down payment on a house, which let's say 25%. So now you're buying $400,000 a year in real estate. So really that 16.4 is probably at least 4x, more than that with the time value of money. But like, as you can see, like if you 4x 16, you're at $64 million of net worth that you're missing out on.
Welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Nuttall, and I'm here today with Barbara Schreihans, founder and CEO of Your Tax Coach, creator of the Write Off Your Life course, and the voice behind Life-Changing Money podcast, which, Barbara, I listened to my first episode yesterday. It was fantastic. So great job on the podcast. You're a really good interviewer. Barbara is a kick-ass tax strategist. She's a business coach, and she's an all-around master when it comes to wealth and finances. Barbara aids business owners and high net worth individuals in saving tens of millions of dollars in taxes while also growing their profits. When she's not leading her team, coaching clients, or dreaming up new goals for her company, you can find her drinking coffee, hanging out with her family, and traveling the world, which means we're going to be fast friends. Those are all of my jams as well, Barbara. So welcome to the show. We're super glad to have you here today.
Thank you so much.
I've listened to a couple of podcasts with you now, and I'm really interested this podcast, our time together today, Barbara, to focus more into the investment benefits of owning real estate. So for the context of this podcast, let's think that the majority of our audience are high income professionals. Some of them likely are going to be W-2 employees. And let's assume that they either have real estate or are interested in making a major pivot towards real estate. So a lot of the tax strategies we're going to talk about, we're going to narrow in just a little bit of the benefits of being a real estate owner. And we can talk about, the definitions and qualifications of real estate professionals and that kind of stuff. I think that would be really, really fun for us to do today.
Sure.
But first, let me just ask you, this is an interesting profession. So how did you get down this path, and what is it that you love the most about being a kick-ass tax strategist?
Well, I really came into this profession because I had an oops baby. I was a junior in college when I got pregnant, and I went to my career counselor and I was like, what major do I need to major in that the day I graduate, I'm going to have a job because I'm having a baby and need to support him. And they told me I needed to go into accounting, which I was very bummed about at first. I changed my major a lot prior to that. I started in criminal justice, and it was a whole myriad of things. But at the time, I was a marketing major. And so to go from marketing, which is fun and exciting, to accounting, I was like, oh my gosh.
Right.
But that's what I did. And I did have a job the day that I graduated, which thank goodness. But I definitely struggled the 10 years that I was in public accounting, because I was like, this industry kind of sucks.
So
you've
boring.
probably all heard from your friends, they don't like their accountant. They never get back to them. They can't talk in a way that they actually understand the information. They never know what they're going to get billed. And, God forbid you have to have a 12-minute conversation with them on the phone because you're going to get billed for it. So I was like, there's so many things wrong with the industry that after 10 years, I finally opened my own company. And now we have 30 employees in 15 different states. And it's kind of crazy, but that's where we are now.
First of all, congratulations. I love to hear stories of entrepreneurs that get put into a situation that at first maybe doesn't seem ideal. What profession do I have to do where I can get a job day number one? And then entrepreneurs do what entrepreneurs do. They turn lemons into lemonade. So congratulations on all your success. If you were to just summarize what separates you and the success that you've had in your space to kind of how the industry norm is, what is it that separates you from the rest of the pack?
Well, I think the big thing is just providing value to your clients. And that's in any industry. Like if you can provide a value and you can communicate an ROI on your service, then it doesn't cost that person or that client anything. You're actually making them money. And it's pretty easy in our industry because it is literally money in your pocket. Like we're saving you money in taxes. So that's a very tangible thing. Probably less so with like business coaching or another service where it's like, what actually is the ROI? But with us, we're selling money at a discount. Essentially, we're like, hey, we can save you X amount if you pay us Y amount. And it's kind of a no-brainer. And so I think really like being value forward, educating first. Like we give away everything for free online. Because I think if people can see how you really are, how you really work, then they're going to want to work with you. And social media, like there's not a ton of accountants out there really like diving deep on things on social media.
And that marketing gene came back out of you. You put it down for a while, but it definitely came back. I was looking at your podcast and your profile picture is you with the podcast and I think a glass of champagne. It's just very engaging and interesting.
Yeah.
So great job there. There was a lot of wisdom in what you just said as it relates to if you can shift your business being a cost to being an investment and you can show somebody that return on investment, you're right. If you're a realtor, if you're a doctor, it doesn't matter, whatever industry you're in, if you can make that shift through educating the potential buyer, you're like you said, you're giving away discounted money, that you're going to be a very popular lady.
Yeah, for sure.
Right on. Well, let's get into the investment side, because in the other podcast that I heard from you, the interviewers were really kind of asking broad financial questions. And so I want to kind of narrow us into this real estate vertical. But first, let's talk about a little bit about what are your favorite investments? And if you don't mind, like, could you kind of just break down for us, like, here's my favorite asset classes, and then maybe why you rank those asset classes or you gravitate towards them?
Yeah, well, funny enough, my favorite asset class is real estate, which we'll talk about today. And really, it's for the huge tax benefits of real estate. Like maybe your ROI on paper might be less than like a cool IPO that's coming out or something. But if you take into account the tax savings and the long-term appreciation and so many other things, like real estate is just on top for sure. So we're putting the most amount of our money there because it saves us on taxes from our active business.
Yep.
From there, like we max out all of our retirement accounts. So the company has a safe harbor 401k, which as an owner, you can put $22,500 away, same as employees, but you can also add on a profit sharing portion where you can then contribute up to $66K. And all of ours goes into a Roth. So a lot of times you hear like a Roth is maxed at $6,500, or if you're a high income person, you can't contribute to a Roth. But that just isn't true. So we do it all in a Roth because we want tax-free money later. And we also just have brokerage accounts that we contribute to every month, and crypto. I know crypto is kind of like a controversial topic, but I love crypto. And I think especially with the Bitcoin ETFs coming out and the halving of Bitcoin, if you know what that is, it's just going to go up from here.
Love it. That was a great overview. So the first takeaway I have is that everything you do starts with what are the tax implications of this investment strategy? It sounds like, is that right? That's the first thing you're kind of analyzing?
Yeah. I mean, it's kind of like ROI and tax savings and what's the actual number there.
Yep, exactly. I love that. And you mentioned the IRA. So are you contributing to I know a self-employed person can contribute to a 401k, and then are you rolling it over to the Roth, or can you dig into that mechanics for me just a little bit?
Yeah. So the Safe Harbor 401k is just like, think of Google that would have a 401k plan that you contribute to.
Right.
And so let's say as an owner, for example, you can put $22,500. As long as when you set up the plan, it has a Roth component, you don't have to roll over anything. It's just put into a Roth.
Got it.
It has to have been structured that way. And if it wasn't you might have to use like a different financial advisor to restructure the plan. But yeah, you just set it up from the beginning, and then the whole 22.5 can go into the Roth, or even up to 66K if you do the profit sharing portion. So yeah, no rollovers. Rollovers from an IRA would be like a totally separate account, and you can do both. So we actually max out a backdoor Roth for 6,500 and our 22,500 for the Safe Harbor 401k.
And who are you, just out of curiosity, who are you doing that with? Like, is that with the Charles Schwab? Like, who's the account you're setting that up with?
No, we use a financial advisor because there's a lot of like landmines that can be in a 401k plan. And I wanted to make sure like it's the best for us and our employees. Like, sure, you can set up a plan just like you can file your own taxes, but like you're going to end up paying more in taxes if you file it yourself. So we use someone.
You need to have a financial advisor who is familiar with this vehicle to help you avoid the landmines.
Yep.
Makes total sense. Great. Love it. Okay. So let's go into this real estate vertical just a little bit. And something else that you said made me want to share a couple of slides from presentations that I've been giving recently that I think will really help people that maybe haven't had the advantages of these massive tax advantages we're going to talk about by being a real estate investor. I really want to make the scale of it or the impact of it be felt by someone who's never really experienced it themselves. So for those of you that are on the podcast, we're going to kind of talk through this. I'd love your feedback on this, Barbara. Those of you who are watching us live will be able to see my screen. But one of the things that I've been talking to real estate investors about is the compound effect of paying maximum tax rates over long periods of time. So this is an example of if somebody were to pay $100,000 in taxes annually for 10 years, then everybody knows that that cost of paying that taxes is 100,000 times 10. So that's $1 million tax liability, right? Well, not exactly, because if you would have had that $100,000, Barbara would have invested it in real estate or crypto or other tax advantaged accounts. And let's just say that over the long period of a long run rate, she would have been able to get a 10% return on investment, which is not crazy by any stretch of the imagination for assets that are held for long periods of time. So the actual cost over 10 years isn't $1 million. It was $1.593 million because she also lost the gain on that money that was paid to the IRS. Let me just show you it over 20 years, because this is when we start to puke in our mouths just a little bit. So over 20 years, you contribute you pay $100,000 to the IRS versus keeping that money because of some tax advantages, same 10% rate of return that you've lost. So now instead of $2 million that you paid to the IRS, your net worth is actually down $5.7 million. And I'll just give you one more just to really rub in the point. You paid $100,000 in taxes over 30 years, your entire career, let's just say. That didn't cost you $3 million, it cost you $16.4 million. So when we look at the net worth of people retiring out without enough assets, you go, oh, well, I just lost $16.4 million to the IRS that I could have had if I would have been more effectively tax structured.
Yeah, I love that.
What are your any thoughts or anything you want to kind of add to that construct, or anything that you've been teaching around this that would be helpful for people?
I mean, I love that graph to show what they're missing out on when they're paying too much in taxes. But I think the flip side of it too is, instead of paying $100K in taxes, that $16.4 million could have been your net worth if you did $100K into real estate. But really, if you think about it, it's not 100 to 100, like 100K in taxes doesn't equal 100K in real estate. Maybe you took that 100K that you're not paying in taxes as a down payment on a house, which let's say 25%. So now you're buying $400,000 a year in real estate. So really that 16.4 is probably at least 4x more than that with the time value of money. But like, as you can see, like if you 4x 16, you're at $64 million of net worth that you're missing out on.
People often wonder, like, what is the difference between people, wealthy people and non-wealthy people? And it's not just the money, because most of them didn't start out with money. It's usually information.
Yeah.
People that are wealthy just have more information and then use that information to position themselves where they're constantly buying assets that appreciate over long periods of time. And 20 years later, 30 years later, it's like, oh, they're the overnight millionaire. No, they just had more information earlier in their life, and then they acted upon that information.
Yeah, that's so true. Even like, I mean, I came from nothing. My parents never had any financial savviness. They filed bankruptcy every 7 years because that was the soonest that they could file bankruptcy.
Wow.
And so growing up, I saw them like file bankruptcy after bankruptcy. They lived off credit cards. Like, and the only reason I am the way that I am now is through education. Like, I just was adamant about it doesn't have to be this way. You don't have to live a life like this. There has to, be other structures and other strategies. And it is just learning, listening to podcasts, reading a ton of books, and just like being a forever student,
Yeah. There's something to be said about coming up from a place where there's a scarcity around money. I know I made a decision early in life. I'm like, all right, experience that. Don't ever want to do that again. And it just kind of propelled me in the opposite direction. It sounds like it did the exact same thing for you.
Mm-hmm. Yeah.
Right on. Okay. So 2017 Tax Cuts and Jobs Act. This was a very favorable act or set of legislation that changes in the IRS code for real estate investors. So could you briefly kind of just give us an overview of what those changes were? And maybe this would be an appropriate time to kind of talk about the phase out if you want to go there.
Yeah. So TCJA, Tax Cuts and Jobs Act in 2017, it was one of the biggest changes to the tax laws that we've ever seen. The last huge one that I can think of is in 86. So it had been a long time coming. And right now, today, through 2025, we have the lowest tax brackets and the best tax incentives for business owners that we will likely ever see in our lifetime. And so be prepared and plan for 25, 26 to be the highest tax rates you'll see. And It might stay there for a really long time. Right now, we're not seeing any reason to believe that it's going to stay the same at all. It has to go up and go up a lot. So one of the biggest changes was on depreciation. And so how you can depreciate different assets. And a lot of people think of their cars, right? Everyone heard of like, oh, now you can write off a 6,000-pound car 100% in your business. Well, this year it's 80%, next year it's 60%, then 40, 20, and then it goes away. But the same is true in real estate as well. So depending on what type of building or asset you're purchasing, you can accelerate the depreciation a lot. Let's like make an example. So say you purchase like a $200,000 single family home, you're probably depreciating that like $7,000 a year. So meaning maybe you get $15,000 a year in rent, you automatically get to take off $7,000. So you're only taxed on $8,000. But then you're going to have mortgage interest and property tax and repairs, all that. So you're still taxed very little on real estate, but you can do what's called a cost segregation study and segregate out everything in that property, because it's not just a building, it's land, it's everything inside, it's all the appliances. I mean, cost seg studies break it down to like the nuts, the bolts, the drywall, the flooring, the type of paint and windows that you have. And so instead of $7,000 of depreciation, now you're going to have anywhere from $40,000 to $65,000 of depreciation in the year that you do the study. So those numbers are huge, but again, they're going down. So like if you have any real estate in 23, do the cost seg study now. We do them in our firm because next year they're going to be worth 20% less. They're going to go down 20% to 60.
And just so I understand correctly, by the way, I'm a massive fan of tax segregation studies. In 2018, once I really understood the power of the Tax Cuts and Jobs Act and how to use what's called bonus depreciation, where you can pull that depreciation forward, we massively pivoted our real estate business from residential into commercial, and it's created incredible tax benefits for us over that period of time. So I'm familiar with them as a user, but what I'm not certain of is, as that bonus depreciation phases out, right, over the phase out period between now and 2025, does that mean that I don't lose that depreciation? It's just that I can pull less of it forward and I have to leave more of it over the next 27 or 39 and a half years. Is that correct? Clean that up for me where I misspoke.
Yeah, that's correct. So you're not losing the depreciation. You just have to use it later. For example, the cost seg study is going to break stuff out, and it's going to say this amount is 5-year property, this amount is 7, this amount is 15, and the rest is either 27 or 39. Well, anything that's 15 years or less, this year you can take 80% of that. So maybe it says you have 100K of property that's 15 years or less. So you're going to get an $80,000 deduction this year. Next year, it would be only 60,000 that you could take that year, but that 40,000 just gets pushed back to later.
Got it. That makes total sense. So do you have an example, like maybe an investment that, you know, you recently purchased, or somebody in your practice that you could kind of explain, like, what is the actual ramifications in terms of the lessening of the amount of taxes they paid that you could share with us?
Yeah, a big one. I think a big hurdle people have is it actually going to benefit me? And the property that I bought wasn't that expensive, so I don't think it's worth it. Well, we bought a bunch of $80,000 condos back in 2020. Now they've doubled, which is great. But back then they were $80,000. And of course, we did cost seg studies on them. Every single one of them got at least $30,000 of depreciation just in that year.
Wow.
So on an 80K property, you're getting 30,000. Like, that's huge.
Incredible.
Into tax savings, it depends on your tax rate, but let's say you're at 40%, 40% of 30,000, you just saved $12,000 in taxes back in your pocket. And think about that. You probably paid 16K, 20K to buy a property of 80,000, and I just got back 12. So that property cost me less than 10% of the purchase price, which is awesome. And so I like to show the $80,000 example because people are always like, oh, it's not going to save me that much. But imagine if you bought a $500,000 property or $1 million property. Like, we just did one on a $2.5 million property, and the client got over $600,000 in depreciation, and he's at the max rates plus California taxes. So he saved $300,000 in taxes.
It's awesome. I mean, it's almost so powerful that if you qualify for this, which we should probably go into next, you either pay taxes or you buy property, but you can kind of choose which one you want to do. We bought a commercial medical space with some partners, and the price on the building was $12.08 million. And the first year tax deduction was $3.6 million. And the cool part is, if you didn't make $3.6 million that year, what did we get to do, Barbara, if we didn't didn't need to use all that to offset income?
Yeah, you can carry it forward to another year when you will need it.
Beautiful. Absolutely, absolutely beautiful. Cool.
So I think of cost segs as, like, I tell our clients, think of it as like a piggy bank. You're saving up this depreciation, and it's there and ready for when you need it. And we don't have to react later. It's proactive. It's already there. And actually, cost segs, a lot of people don't know this, they're actually required by the IRS. We've seen audits where the IRS comes in and they audit a Schedule E, a rental form on your tax return. And they say, oh, well, this shouldn't have been 80% building and 20% land, which is what most accountants do. It should have been 10% this and 20% this and 30% this. So you should have taken an extra X amount of depreciation, and you didn't. So we are going to take it, and you can never use it.
Wow.
Yeah, most people don't know that. It's crazy.
That is absolutely crazy. So wow, another reason to be really thinking down these lines. So you brought up an interesting point. You called it a piggy bank, which then makes me think, okay, if we believe that it's likely that the tax rates are going to go up significantly in 25, 26, and hard to know, right? Because we don't know who's going to be in the White House. We don't know, but chances are, I mean, we're running a $1.8 trillion deficit this year. We're not bringing in enough money to cover our expenses. Chances are taxes have got to go up sooner or later. So then it would make sense in my mind to maximize this piggy bank of savings through depreciation so that we can offset the presumably higher taxes that are going to come our way in 25 and 26. Have you thought through that? How would you describe or advise around that?
Yeah, exactly. We know taxes are going to be going up in 26. Like it's a fact. So have it there and waiting for you. Because also at any time they could say no more cost seg studies. But if you've already taken it, they can't take that away from you. So
So one other question around that, this piggyback philosophy that you brought up, do I have to take that depreciation this year to offset my income? Or can I say, no, I'm going to pay today's tax rate on today's income because I want to push this piggy bank forward into 2026? What limitations or what am I missing there?
kind of, yeah. So you can actually, so the cost seg study, like I said, it breaks it into 5, 7, 15, etc. property.
Mm-hmm.
You can elect out of certain years bonus depreciation. So let's say I want to take all the 5-year bonus today, but I don't need 7 or 15 because I don't need that much. I can elect out, but you if you elect out, you're electing out of all the 7-year. You can't like pick and choose just this 7-year, just that. So you're electing out of like these little buckets of years.
Great. That's really insightful because today my tax rate may be 30% with some offset. But if I think it's going to be 40 or 50% in 2026, that piggy bank actually gets more valuable in those future years. That's really, really interesting. I hadn't thought of that. Thank you.
Yeah. And like we just met with our financial advisors this week, and we were talking about this is kind of the time of year where you think about profit sharing in your retirement plan. So as a business owner, you can choose to do profit sharing, but you also have to do it for your employees as well. You can't discriminate against yourselves versus employees. So it was like, hey, should we profit share this year? And they brought up the point as well of, well, taxes are going up in 25 and 6. So why don't you not profit share this year, put more into real estate, and then profit share later when those bonuses essentially that you're paying out, you're saving more in taxes. So I thought that was a cool point too.
Really smart tax strategy, really smart. So let's talk about who can use this depreciation from tax segregation studies, who can't. Let's say that I'm a high earning W-2 employee. And my wife doesn't. She manages the home office business, the real estate, or some sort of a scenario like that. Who can use it? Who can't? And is there any limitation to the amount of actively earned W-2 income that can be set off by a spouse?
Yeah, good layup on that scenario. I see what you did there. I'm proud of how much you know in taxes. But so the tax laws around depreciation and taking real estate losses. If as a family you make over 150K a year, you can't take your real estate losses, meaning they can take you down to 0.
Yep.
So if you have rentals bringing in 20K, you could take 20K of depreciation, but you can't make it go negative to then offset your W-2. Unless a few scenarios. One is your spouse or someone without a W-2 can qualify as a real estate professional. And that does not mean someone that's licensed. I'll go into what a rep is in a second. Or the other scenario is if you have active rentals, which typically means an Airbnb or any short-term rental with average stays of 7 days or less. So let's get into real estate professional. Let's say you're a high-income W-2 earner, you want to buy a rental property, and you want to do a cost seg to help offset your W-2 income. Well, if you want to take the losses, your spouse would have to be a real estate professional, meaning they have to spend more time in real estate than anything else that they work in. But if, let's say they're a stay-at-home wife, mom, so they're not working somewhere else, so they check that box. They're going to spend more time in real estate than anything else.
Yep.
Actually, I'll use a client example. I have an MLB player client. He's a very high income W-2. They're all W-2 earners on the MLB, and they have to file in every state that they play in. So he files a W-2 all over the place. His wife is a stay-at-home mom because she doesn't have to work, right? He's a pro baseball player.
I'm sure he's a lot of work in and of himself. Just taking care of him.
Yeah.
I know that's true for me.
Yeah. So they're buying a ton of real estate this year, and she's going to be the real estate professional because she doesn't otherwise work. And you have to spend 750 hours in your real estate activities. So that would be things like remodeling the property, repairing the properties. Maybe you drive by and pick up your rent checks just because you need the hours, right? People can direct deposit these days, but might as well drive by and get more hours. Maybe you drive by once a month to just check on the property and make sure they're not trashing it. You're researching different markets. You're checking Zillow. You're doing analysis on should I buy this property or that. So you're on Excel trying to analyze those properties. So all that activity, you need 750 hours or more. There's some other nuances, but I don't want to bore people. So if you're a high income W-2 earner, you want a spouse to be your rep. Once they can qualify as a rep, you can then cost seg your properties and take those hundreds of thousands of dollars of depreciation, whatever that might come out to, and it'll offset your other income, whether it's business or W-2. Now, the other scenario that I really like is Airbnb or short-term rentals, because you don't have to be a rep for those. And I like this strategy in Q4. A lot of our clients are purchasing a property right now. They're going to Airbnb it to the end of the year, cost seg it, get all the depreciation. And then next year, they don't really like Airbnbs. So they say next year, I'm tired of managing my own Airbnb, so I'm going to turn it into a long-term rental. And then they don't care if they offset their income from that depreciation loss because they're going to buy another Airbnb in Q4 next year. So it's kind of this Airbnb to long-term flip every year so that they still get the cost seg amount, but they don't have to be a rep. They don't have to stress about doing that.
What a great strategy.
Because sometimes people don't have a spouse or they don't have a spouse that's willing to not work other places.
I've got a bunch of questions. Let's see if I can remember them all. Let's start with the last one around the strategy of moving from short-term rental, which I think they classify as, is it called active management or active earned? What's that called?
We just call it short-term rentals because they're considered active income as long as the average stay is 7 days or less.
Got it. Okay. So with that strategy, you could have two W-2'd or two fully employed spouses.
Yep.
And as long as they have how much period of time in the calendar year do they need to be used as nightly rentals or rented out? Is there a minimum?
You'd want to have 2 stays so that the average stay is less than 7 days.
Got it. So only the bar here is pretty low.
Yep.
You're actively managing this property. You have 2 stays. The stays are less than 7 days. Boom, you qualify and you can take that depreciation to offset 2023 income.
Yep.
Fantastic. Such a great strategy. Back to the rep, the real estate professional designation. You mentioned something about it not being correlated with a realtor as a realtor. So I'd love to go back to that. But the other question I had was, is there a limit of the amount of depreciation that the spouse can take that offsets the other spouse's W-2 income? Like, is it, could hypothetically, could you have $10 million in depreciation from the spouse that would offset the W-2 income?
Yeah, there's no limit.
Awesome.
And then, go ahead.
Powerful, I said.
Yeah. And then your other question was
the realtor, any kind of correlation between real estate. Maybe we just further define real estate professional versus realtor.
Yep. So a lot of people think when they hear the term real estate professional, you have to have your license, and that's not true. You just have to spend more of your time in real estate than any other business or profession that you have. And so, you don't have to be licensed. Like we have construction guys that are spending a lot of time on their properties, remodeling and things like that. Or you could just be that landlord that hops around property to property to pick up the rents, and somehow you get 750 hours a year doing that. So you don't have to have your license.
Beautiful. Very good. Now, let's flip the coin. Let's say somebody is a licensed realtor. Do they automatically qualify as a real estate professional to take this type of depreciation?
No.
Okay.
Because they still have to spend the 750 hours. So if you're not actively spending that time in real estate, there's a lot of part-time real estate agents. And some of that time that you are spending as an agent might not qualify. There's a lot of little nuances in it. There is a loophole, if you will, that if you're a 5% owner or more in a brokerage, that you kind of automatically count as a rep. So that's kind of a cool one. If you're someone that's like, man, I don't know that I'm going to hit the hours and I don't know this or that, just like start a brokerage with someone and be a 5% or more owner.
Wow. I had never heard of that before. That's very interesting. Very cool. Super helpful. So this bonus depreciation that is phasing out over the next couple of years, do you think there's any chance that let's just say we get a pro real estate Republican in the presidency next year? Do you think there's any chance that this thing gets extended in any way, or you think it's over, baby?
I hope it is not over. I think what will happen. So when it went down to 80% this year, it didn't hurt people that much.
Yep.
But I think once it goes to 60, and especially when it goes down to 40, it's going to change, especially the investment side of real estate a lot. Because again, if you're someone that's like, should I put money into real estate or should I put money into stocks or something like that? Well, right now, real estate's a slam dunk, and it's not so much going to be a slam dunk next year or the year after. And so I think once we kind of see sales slow down in the investment space, then politicians will wake up to how it's affected people. But also, I always say, like, look at what politicians are doing, and they want these same benefits that we do. And so they might reenact it just because they also want the real estate benefits too.
Yeah. Yeah, that's really interesting. If you're someone who's positioned such that, like the illustration you gave, that on a $2 million house, there was $600,000 in depreciation that first year. And let's just say they're at a 50% state and federal, that's $300,000 less in taxes they're paying. You almost have your down payment just from the amount of taxes. So once that benefit goes down, and now let's say I only have $100,000 tax benefit in year one, but I still need to come up with $400,000 down, that it gets less enticing. So that's interesting to think about how those tax benefits are phasing out at the same time that commercial real estate, especially office space, has some significant headwinds. So I could see how they could, justify, hey, we're extending this because we really need to shore up what's going on in the commercial real estate world.
Yeah, exactly. Can I share like 2 more examples of fun like Airbnb savings too?
Please.
Another good way to get a cost seg study to offset your active income would be, say you buy a property right now in Q4 of any year, Q4, you buy a property, you Airbnb it so it's active, you cost seg it, but then you realize, one, I don't like Airbnb, I don't want to manage it, but you're like, maybe this would be a really great personal residence. So then the next year you move into it, and that's okay if your intent changed. Now that can't be your intent from the beginning, but maybe you only buy places that you would want to eventually live in, because that's a great retirement strategy. So we see that a lot where our clients will Airbnb Q4, they get the big cost seg, they offset their taxes, and then next year they're like, actually, we want to move to this property. And you still got to take the big tax deduction in year one. So that's kind of the personal residence one. There's also another one with personal residence is, the personal exclusion. So if you have your house for 2 years, you can exclude up to $500K of gain if you're married.
Yep.
So say you live in it 2 years, and then years 3 through 5, you want to rent it out. So you live in it 2 years, then you rent it for the last 3. Well, cost seg it in one of those years, take the big depreciation deduction, and then in year 5, you still get that $500K exclusion because the rule says you had to have lived in it 2 of the last 5 years, and you have. So you kind of get a double deduction. You get the exclusion and the cost seg depreciation, which is cool.
Wow, that blows my mind. Okay, let me see if I can say that back. So many of us who have owned a home from, let's say, 2018 till now, we've probably seen our home values double or thereabouts in many areas of the United States. Yeah. So if I'm sitting on over $500,000 in equity or gain, I should say, then I've got to pay capital gains on the rest of that. But what I could do if I didn't want to pay that capital gains is I could lease out the property. As soon as I have a tenant in it, if I qualify for this, I can cost seg that property because it just has to be producing income for 1 day for me to do a cost seg. Is that correct? In service, I think it's called. So now it's in service. I cost seg it. And then when I go to sell, I can also take the 500,000 exclusion.
Yep. Yeah. Or now that it's a rental, you can 1031 it. Whereas if it was personal, you can't 1031 it. So
let's talk about that. That's brilliant. Explain that to us.
Yeah. So if it's a personal residence, right, you get that 500K exclusion. But investment properties get something what's called a 1031 exchange, where you just have to exchange that property for another property and you just put the gain in it. So say you bought a house for 500, it's now worth 600. You'd take that 100K of gain and put it into a new property. You don't have to pay anything in taxes on that capital gain. You can do that forever and ever. Never pay taxes on it. Your kids then inherit the property at the fair market value when you pass away. So they pay nothing in tax either. I call it a buy, borrow, die method. But
love it.
The 1031 exchange can defer your taxes forever.
Generationally.
Yeah. And that's how Trump, built his wealth. So Trump is very well known for 1031 exchanges.
Yeah. Let's dig into that just a little bit, because I think there's a lot of people in this exact situation, Barbara, where their house is, doubled. They're sitting on massive amounts of equity, far in excess of the 500,000. Not equity. I'm using the wrong word. Gain, because those are different things.
Yep.
And so I decided to rent out my home. And I can tax seg from day one as soon as I have a paying tenant in there. How long would you recommend that we rent out that home before we 1031 exchange, so that we don't really, trigger the IRS? Like, what do you think is an appropriate way to do that?
I think you could 1031 it at any time, right? Like at least a year.
But
the sweet spot, I would say, is 5 years, because you could have what's called depreciation recapture on a little bit of that cost seg. It's not a lot, and it's not something to be super concerned about, but I would probably wait 5 years and then 1031 it, but you don't have to. I think paying a little bit of tax on the recapture is still worth buying a bigger, better investment property.
For sure. And since I'm in the mortgage world, let me give you one other reason why this might be brilliant right now. Many of us that have owned our homes, 5 years or so, we probably took advantage of a refinance in 2020, 2021. So we're probably sitting on 3% mortgage loans, which means if we turn that property into an investment property, massive chance you're going to have some really solid cash flow there. Yeah. So we take advantage of paying down that 3% mortgage for another 3 to 5 years as we're renting it out. We get the tax segregation benefit, we get the cash flow, we let the tenant pay down and amortize our mortgage, which those of you who aren't familiar with amortization charts should know this before you think about selling a home with a 3% mortgage on it. If you look at an amortization chart of a $600,000 home with a 3% mortgage, and then you look at an amortization chart of a $600,000 loan with an 8% mortgage, you're paying like 3 times the amount of principal each month on the 3% mortgage as compared to the 8% mortgage. So I think people that are selling these homes with 2 and 3% rates they really just don't know math, because if you look at that amortization and then on top of the benefits you're talking about, it's an extraordinarily wealth vehicle to do what you're talking about. Tax seg it, take the advantage, use the low mortgage rate for as long as possible, and then 1031 exchange into another investment.
Yeah. And if you have a ton of equity in that house, I mean, get a HELOC or something, exactly. Pull the money out and buy more rentals.
Hey, let's talk about that, because a lot of people don't understand that, Barbara. When you pull, let me just have you explain it. Is there any tax implication to pull money out of a property via some sort of refinance vehicle?
Well, guess what? Loans are not income to you. So it's literally tax-free money. And when else does that happen except when you die and your kids get life insurance money? Like, there's no other way to get tax-free money except through loans. So yes, you're going to be paying a little bit of a higher interest rate on a HELOC or something, but factor in the tax benefits of it. It's tax-free money that you then don't spend it on stupid shit, like buy a house with it and buy a rental property with it and have it cash flow for you. I mean, it's brilliant. Like easy.
It's brilliant. Well, if you think about it, if you sell an asset and you pay year one, let's just say, what's capital gains at right now?
Well, it's only maxed at 20%. So that's another thing. In 26, that could go up into the 30s.
Yep. So year one, if you sold an asset versus borrowing money against an asset, it's a 20% return on investment year one, because you would have lost 20% to the IRS. So these are really important things that I don't think people have as much forethought into strategizing before they take these actions, which is why they need to follow you and learn more about your teachings and all the things that you offer. So let's kind of go there. I'm guessing that the level at which we're talking about, at least a third of this is absorbed, but a lot of it isn't going to be absorbed on the first conversation if you're not doing these things actively. So where do people follow you? How do they set an appointment with your company? How do you suggest people learn more?
I hang out the most on Instagram. So follow Your Tax Coach on Instagram. Our website's yourtaxcoach.com. We're basically your tax coach on any social media, but definitely go to our website. We're happy to chat. You can book a free call, but we do tax strategy, cost segregation studies, like I mentioned, bookkeeping, tax prep, like anything related to your taxes or accounting, we got you. But we also sell a bunch of courses as well. So our most popular course is Write Off Your Life, which teaches business owners how to take more expenses that they are spending personally and write them off in the business. We have an S Corp course. We're coming out with a real estate course next year. I haven't said that on any podcast before, but it will be out in Q1 next year.
I would love to take it. I was just thinking that whole idea of taking your primary, converting it into a rental, tax seg, and then 1031, like that can be a whole real estate course right there. I mean, that is such a powerful wealth building tool.
Yeah.
So let's end with the question that I always love to end with, Barbara, which is, what myth about finances or wealth or becoming wealthy do you wish people knew the truth about, or do you see people tripping over themselves the most?
I think you touched on it in the beginning of like, you don't have to have a lot of money for this kind of stuff to work. And you don't have to have a lot of money to be like rich in knowledge and rich in education and all of these things. And it is more about like taking action than it is about, you know, how much you have in a savings or how much revenue you bring in your business or something like that. And so just start with something and like invest a little bit into something and just start learning.
So good. Are you familiar with Kiyosaki's game called Rat Race, the board game?
We have it.
It's so good. And anybody who has kids, the kids should come with this board game, in my opinion.
Yeah.
But the cool thing that I learned as a 18-year-old playing this game with my grandmother was that the school teacher had just as much probability of becoming wealthy as the pilot and as the doctor, because it's more about the savings rate and it's more about the investment strategy than it is the amount of income coming in. And that's what you're talking about. You can become wealthy if you have the information and you take action regardless of the income level.
Yeah.
So cool. Thank you for sharing so generously. I think there was more actionable information in this podcast than maybe anyone I've ever done before. So thank you.
Thank you.
And I appreciate you. And I hope you will come back and visit with us again sometime soon.
Of course. Thanks for having me.